Unless you've been living under a rock, you probably know that the Chinese economy is facing serious challenges. There has been a long ongoing decline of the stock market, a struggling real estate sector, deflation, record low consumer confidence, and a sputtering export. Hello, friends, I hope you're having a fantastic day and welcome to Inside 360 China Edition. In today's video, we'll be diving deep into China's current challenges. We'll look into China's recent history to see if it gives us any clues about what the future might hold for China. But before we get started, let's begin by exploring what's currently going on. The Chinese authorities have been announcing support packages one after another recently in an effort to stabilize the economy and prevent the stock market from dropping further. Just in the past 2 weeks, they have implemented measures such as reducing bank reserve requirements to offer affordable lending for investors, increasing costs for Chinese investors to purchase overseas ETFs. Additionally, negative comments about the Chinese economy on the internet have been restricted. However, despite historically low interest rates and various support policies in place, the economy is not showing signs of recovery. The situation has become so serious that this week Xi Jinping himself is getting involved, as he is scheduled to have a meeting with financial regulators to discuss the stock market and the ongoing market decline. It is still uncertain whether new support measures will be announced. To understand what is going on, it is important to get some perspective on how the Chinese got here. So let's go back a few years so we can better understand the current situation. The Chinese stock market from 2005 to 2020 tells an exciting story of fast growth, investor excitement, and the creation of substantial wealth, mirroring the broader economic rise of China itself. This period is defined by China's emergence as a global economic powerhouse, with its stock markets playing a crucial role in this transformation. Let's delve into the tales of success, the impact of individual investors, and the overall optimism that defined the Chinese stock market during these years. During this period, we witnessed numerous success stories that showcase the incredible opportunities for wealth creation within China's flourishing stock markets. Companies such as Alibaba, Tencent, and Baidu not only became widely recognized in China but also gained global recognition, attracting significant foreign investment. The initial public offerings, IPOs, of these tech giants were some of the largest in history, resulting in immense wealth for their founders and early investors. Jack Ma of Alibaba, Ma Huateng of Tencent, and Robin Li of Baidu emerged as some of the wealthiest individuals in the world, serving as symbols of the remarkable achievements that innovative entrepreneurs could attain in China's dynamic economy. The general Chinese public took notice. With limited opportunities for Chinese individuals to invest overseas, they flocked to the stock market. One distinctive feature of the Chinese stock market is the prominent role played by retail investors who, for a significant portion of this period, accounted for approximately 80% of the trading volume on Chinese stock exchanges. This stands in stark contrast to more developed markets, where institutional investors typically dominate. Retail investors in China, often motivated by speculative interests and a willingness to take risks, made a significant impact on the market's volatility and its dramatic ups and downs. In the latter half of 2014, for instance, the Chinese stock market experienced an incredible surge, marking the beginning of a remarkable boom that lasted until the first half of 2015. This period was filled with optimism and increased investor activity driven by government support, easy monetary policies, and the popularity of margin financing. The Chinese government, through state-run media, encouraged individual investors to enter the stock market, presenting it as an attractive opportunity for wealth creation. These encouragements were part of broader economic reforms aimed at shifting China's economy from manufacturing-led growth to a more services-oriented model. As the People's Bank of China implemented a series of measures to stimulate economic growth, borrowing costs decreased, making it cheaper for companies and individuals to invest in the stock market. The allure of quick profits led to a surge in margin trading, where investors borrowed heavily to buy stocks, increasing their potential returns, but also their risks. By mid-2015, the Shanghai Composite Index had more than doubled in value in just about a year, reaching over 5,000 points and pushing price-to-earnings ratios to unsustainable levels. The market was built on leverage and speculative bets rather than solid economic fundamentals. The turning point came in June 2015 when the bubble burst, leading to a rapid and significant decline in stock prices. The initial trigger was a regulatory tightening on margin financing aimed at reducing speculative trading. This caused a massive sell-off as investors rushed to cover margin calls, resulting in panic selling that further accelerated the market's decline. Caught up in the wave of optimism, many of these investors, who had limited experience or understanding of the risks involved in stock trading, found themselves in a difficult situation. The encouragement from the government and the media had portrayed the stock market as a guaranteed path to wealth, leading to a widespread belief in the market's unstoppable growth. However, when the market suddenly turned, catching many off guard, the consequences were severe. The use of margin financing, which allowed investors to borrow money for stock investments, exacerbated the losses, leaving some in a much worse financial position than before. In the aftermath, the streets of China's cities and towns were filled with stories of those who were affected. Small investors who had hoped to achieve financial security through the stock market found themselves back at square one, or even worse, burdened with debt. Families who had pooled their resources to invest saw their collective savings vanish, forcing them to reevaluate their future plans and tighten their budgets. The impact was not only financial, but also psychological, as trust in the stock market declined, and a more cautious approach to investing replaced the belief in quick financial gains. The government's initial efforts to stabilize the market, including suspending initial public offerings, buying stocks directly through state agencies, and implementing further monetary easing, struggled to restore confidence. Investors, concerned by the steep fall and uncertain about the government's ability to control the market, continued to sell their holdings, worsening the crash. The aftermath of the crash was devastating, wiping out nearly $5 trillion in market value and leaving millions of retail investors, many of whom had invested their life savings or borrowed heavily, in a difficult financial situation. Eventually things settled down though, but not before the market had lost nearly 50% of its value. However, considering the robust annual economic growth in China during the mid-2010s, many recovered from their poor investments and, in due course, everything returned to normal again. Confidence was restored, creating ample opportunities and a friendly environment for entrepreneurship. The 2015 market crash soon faded into nothing more than a distant memory for most. Fast forward to today, and we can see that the Chinese stock market is going through another challenging phase. However, this time it seems to be different. Instead of a sudden crash, the market is experiencing a prolonged downturn. And that's not the only thing that sets it apart. Let's take a closer look. At the heart of the current decline is a crisis in another sector, where many Chinese people have made significant investments: real estate. In an effort to boost economic growth, both the central and local governments implemented measures to encourage investment in real estate. They relaxed restrictions on foreign investment and introduced tax incentives, attracting a surge of domestic and international capital into the market. Local governments, which heavily rely on land sales for revenue, eagerly allocated land for development. Meanwhile, the central government's investments in infrastructure created new urban areas that were perfect for development. The financing for this boom was made possible by the liberalization of China's financial sector. Banks, which used to be more cautious in their lending practices, opened the doors to credit for both developers and home buyers. Additionally, the shadow banking system, which operates alongside the traditional banking sector, provided an additional source of credit, although with higher risks. This easy access to financing fueled a construction frenzy across China's cities, with cranes and new high-rises quickly changing skylines. Fearing a repeat of the 2015 crisis, this time in the real estate market, Xi Jinping took measures to limit lending in an attempt to slow down investments. While these policy changes were effective, they also revealed another issue. Many large real estate investment companies, such as Evergrande and Country Garden, were heavily indebted. As lending opportunities became more restricted, these firms were no longer able to finance their debt and sustain ongoing projects. In an effort to raise cash, they started selling off real estate, which resulted in an oversupply and subsequent price drops. After the stock market turbulence in 2015, a lot of Chinese individuals put a significant amount of money into real estate, thinking of it as a safe and dependable investment for their retirement. Unfortunately, the falling prices and the bankruptcy of some major real estate developers in China have seriously shaken this belief. Consequently, many Chinese investors are now experiencing the decline in value of their real estate investments, which is affecting their savings for the future. Moreover, the global economic slowdown, resulting in fewer job prospects, has also played a part in historically low levels of consumer confidence in China. This seems to be one of the major differences between now and what happened in 2015. The stock market crash back then appeared to be solely a crash of the stock market. The overall economy was not significantly impacted, so there were still ample job and career prospects, and the entire economy recovered relatively quickly. However, this time, the economic decline appears to be more prolonged. Consumer confidence is currently low, job opportunities are scarce, and the government is hesitant to provide stimulus. So, how severe is the situation? Let's take a look at some figures. Let's begin by taking a look at the stock market itself. The Shanghai Composite is currently showing a clear downturn, with lows not seen since March 2020. This means that all the gains made in the past 4 years have been completely wiped out. Upon closer examination, we can notice some significant fluctuations, but the overall downward trend seems to be getting worse, which is causing panic among investors. When we compare the Shanghai Composite to the S&P 500, the situation becomes even more concerning. While the S&P 500 is reaching new highs, the Shanghai Composite is struggling to recover and remains at its lowest point in 4 years. Now, let's move on to the inflation numbers. Despite China having record low interest rates, deflation is still a problem. This is mainly due to lower housing prices and a lack of consumer confidence. People are postponing their purchases, resulting in overall low demand. In recent months, the Chinese government has been implementing aggressive measures to stimulate the economy. However, most of this stimulus is directed towards manufacturing, which is leading to an increase in supply and further deflationary pressure. As we think about the complexities of China's current economic situation, many people are wondering if China might be heading towards a time similar to Japan's lost decades, a period marked by slow growth and consistently low inflation. The similarities between China's current economic challenges and Japan's post-bubble era are concerning and raise valid questions about where the world's second largest economy is headed. Once seen as a symbol of rapid growth and unstoppable expansion, the Chinese economy is now facing a range of issues that suggest a possible shift towards a slower economic phase. The prolonged downturn in the stock market, along with challenges in the real estate sector, which was previously considered a safe investment, paints a picture of a country at a critical economic crossroads. The pressures of deflation, worsened by falling housing prices and declining consumer confidence, further complicate the outlook, making it difficult for traditional measures to boost the economy. The government's response, characterized by support packages and regulatory adjustments, resembles the actions taken by Japan during the early stages of its economic stagnation. However, it remains uncertain how effective these interventions will be, as there are underlying structural challenges, such as high levels of corporate debt and demographic changes, that continue to pose significant obstacles. The involvement of President Xi Jinping in discussions about the stock market and economic policy highlights the seriousness of the situation and the government's determination to prevent a deeper crisis. However, China's situation differs in several ways. Unlike Japan, which faced a rapidly aging population and a lack of significant economic reforms during its lost decades, China still has considerable potential for further urbanization and growth in domestic consumption. Moreover, China's role as a global manufacturing powerhouse and its increasing influence in technology and renewable energy sectors provide opportunities for diversification and innovation within its economy. Therefore, the question is not just whether China will follow in Japan's footsteps, but how it can navigate its current challenges while capitalizing on its unique strengths. The answer may lie in the government's ability to implement structural reforms that address the underlying causes of its economic problems, such as reducing corporate debt, promoting innovation, and strengthening social safety nets to boost consumer confidence. Although measures are being taken at the moment, most economists agree that they are insufficient to change China's current trajectory. What is needed is fundamental reform. In order to have a well-functioning and growing capitalist market, freedom is vital. This includes the freedom to start businesses, express oneself, and have financial freedom, so that individuals and corporations can invest when and where they desire. It is difficult to imagine these kinds of reforms under the current leadership. That's all for this episode. If you have any questions or would like to discuss the topics we covered, please feel free to leave a comment below. We really hope you enjoyed this episode, and we can't wait to see you again next week. Take care, and bye-bye.